Good morning, everyone. Before I start, I thought I would try and involve you a little bit and maybe ask a question or two. We're going to be talking about the macroeconomic outlook, global outlook. And before we do that analytically, I thought I would ask you, how are we feeling? How does it feel if we were to ask you, are you feeling optimistic, pessimistic, or neutral about the world economy? So how many people feel optimistic? Can I see a show of hands, please? Optimistic. I'm sorry? Cautiously optimistic. Okay. Cautiously optimistic. All right. With Annie leading the way, cautiously optimistic. How about not so optimistic? Cautiously pessimistic. Whoa. All right. And neutral. No strong views one way or the other. Okay, so that is the majority. And it is consistent with what the IMF has been saying. If you look at their outlook presentation that they made just a couple of weeks ago, the title is Slow but Steady. Not too hot, not too cold, somewhere in the middle. But there are some inconsistencies here. If you look at what's been happening in the stock markets, for example, you would think that the world is exuberant right now. So we'll try and unpack a little bit of that. Now, the other thing that I wanted to say before I formally start is that the world of economic outlook, or coming up with outlook, used to be a lot easier before. It was really about economics. We had some variables, unemployment, interest rates, inflation, and then we saw how that mapped onto foreign exchange, commodity prices, asset prices, etc. The relationships were fairly stable. But it's different today. And academics like to characterize the world that we're in today as a world of uncertainty as opposed to risk. And I'm not sure whether in other languages, whether in Mandarin you have different words for uncertainty and risk. It is a very important distinction. Risk refers to a situation in sports, for example. If you're playing football, or badminton, or squash, you know what the rules are. It's a level playing field. The walls, the structural walls are fairly static. And the game happens within the boundaries. This is where the volatility happens, but within static structural walls. That's risk. And that is kind of the world that many of us have been used to, at least for 20 of the last 30 years. Today we're in a world of uncertainty, whether you're not really sure what the rules of the game are, whether the referees are really neutral. Are the referees fighting between themselves? It's much harder to quantify uncertainty of that kind. And therefore, it's much harder to model the risks of that kind. And so, I think it's not as useful to talk about forecasts in an environment like this, and much more useful to talk about the drivers of outlook. What are the strategic forces that are causing the walls to shift, the ground to become tilted? Much more structural, as opposed to the smooth, normal distribution that we have been used to in the past. But before we do the way that I would like to do it, which is the drivers, the strategic drivers, let's look at the traditional approach very briefly. By the way, let's do another show of hands. Let's talk about the US dollar. How do you feel about the dollar right now? Again, three possibilities. By the end of the year, the US dollar will be stronger than where it is right now. It'll be weaker, or will it be roughly the same? So first, how many people feel it'll be stronger at the end of the year? Okay, good number. How many people feel it'll be weaker? Okay, team weak is mainly on that side, a little bit over here. Oh, okay, a lot more people feeling it's weaker. And I'm guessing the rest of you are in the neutral camp. So the traditional way to do it is to talk about forecasts. What will be the level of the dollar versus the Japanese yen or the euro and so on and so forth. Since I mentioned the IMF, let me talk a little bit about what the IMF is saying right now. So global growth, they're saying, is going to be 3.2% this year and 3.2% again next year. Looks like that is the steady state growth rate that we would be in. And inflation is coming down towards the 2.5% target. It's come through 3%. And if this actually materializes, it's not a bad outcome. Because 2 years ago, global growth was 2.3%, and inflation, average around the world, was above 9%. So if they are really able to, if they're right with their forecast for the end of this year, then the Fed in the US would have done the impossible job of bringing inflation down without inducing a recession. That has hardly ever happened in the past. I think 1995 was the last time that it had happened, and the conditions were much more favorable. So that is the base case scenario that the IMF is projecting right now. If you zoom in further down into what that 3.2% growth means, they're saying that it's 2.7% in the US, and it's 4.6% in China. And the US and China together make up about 40% of world GDP. These are really the two economies that matter in terms of contribution to global growth. The EU, UK, Japan, they're not growing much, less than 1% projected for the next 2 years. Closer to Asia, India, looking good, 6.5% growth for the next couple of years. Indonesia, looking good, 5.5% growth in the next couple of years. But as you know, in terms of the level of GDP, India is about a quarter the size of China, and Indonesia is less than half the size of India. So in terms of contribution to global GDP, it's still the US and China that we are keeping an eye on. And these countries themselves are, their economic fortunes depend on one or two factors that are on a knife edge. Elections in the US is a coin toss. What happens to China with the property market deleveraging is also a significant factor. So you can see that risks are piling on because we depend on a small number of factors to determine what happens to the global economy. The problem is that we need more engines of growth. And the hope was that emerging markets outside of China would help pick up the slack. If you take ASEAN 5, for example, the growth projected now for emerging markets in general, but ASEAN 5 as well, is probably 0.5 percentage point lower than what we would have projected before COVID, and 1 percentage point lower than what we would have predicted before the Trump trade war of 2018. So there are positive individual stories. You hear about supply chains moving more into ASEAN. You hear about domestic consumption going up, investments going up, but the numbers at the moment do not add up to help the global economy grow at the rate that we were used to in the past. But that is okay, because we're not in the world of risk, we're in the world of uncertainty. In the world of risk, we would extrapolate from the trend that we were seeing and say, we can't really see how that extrapolation would work going forward. But in a world of uncertainty, we talk about scenarios, and we talk about a little bit more of imagination of where the new drivers of growth might come from. And of course, the drivers of growth and the drivers of risk can be the same. It's the same strategic drivers that we need to be looking after. So there are 5 strategic drivers to keep in mind. I think I have about 20 minutes left, so we'll probably have about enough time to go through 3, maybe 4 of them. But let me just tell you what I think the 5 drivers are, and you can always grab me later on and talk about the ones that I don't have time to go through right now. And these 5 factors have been with us for some time. It's just that I believe that this year, all of them together are precipitating or accelerating and impacting us at the same time, which is why the title of this talk is At the Vortex. It's like the base of a cyclone where too many things are impacting the structural walls of the playing field at the same time. So what are the 5 Ds? And as I said before, we need to place a lot more weight on scenarios and imagination and less on actual forecasts or specific outlook, which might change quite frequently. So the 5 factors, and I'm going to list them as the 5 Ds, are the discount rate, interest rates, divergent globalization. Some people would say deglobalization. I would call it divergent globalization. Number 3, digitalization, but a very different flavor of digitalization now than what it used to be a couple of years ago. And of course, what you're here for, decarbonization. And the last one is demographics. So these are the 5. Let's take them one at a time, but as business executives, as risk managers, as opportunity seekers, these are the 5 things that I suggest you keep in front of you and use them to assess the risks and opportunities around. So discount rate. One of the forecasts that we have been getting wrong consistently is the forecast on what's going to happen to interest rates. What will the Fed do with policy interest rates? In December, so 4 or 5 months ago, we were forecasting 6 rate cuts for the year 2024. How many cuts have we had so far? None, 0. We'll be lucky to get 1, maybe 2 by the end of the year. It is a tremendously, wrong prediction or a significant one to get wrong. And rates will now remain higher for longer, which means cost of funds is going to remain higher for longer. And to think about how dramatic that is, let's quickly take a look at how we got here. So 2019, the year before COVID, was already the weakest year for global growth that we had seen since the global financial crisis. The Fed had hiked rates in 2018, and then in 2019, they had to quickly cut it back down 3 times. Remember that the trade war was still very much in focus, and we didn't have that resolution or the phase 1 settlement for the trade war until the 15th of January 2020, a couple of weeks before COVID became center stage. And so going into COVID, interest rates were already negative in the Euroland, negative in Switzerland, of course negative in Japan, and then the monetary authorities had to stimulate. How do you stimulate the economy when rates are already 0 or negative? You pump money into the system. Quantitative easing. We know that after the global financial crisis, the amount of money released, the way to think about it is the size of the Fed balance sheet that went from 1 trillion to 4 trillion. And then when COVID hit, it went from 4 trillion to 9 trillion. More quantitative easing was done in the 1 year after COVID than was done in the decade since the financial crisis. That is a lot of money sloshing around, which meant that in 2021, every asset you can think of, or even non-assets, was rising in value. Do you remember this, the crypto with the dog face on it, Dogecoin? Did anyone buy that, invest in Dogecoin at the time? There was Dogecoin, there were NFTs, some good things got money too. Green bonds, unicorns. Virtually every startup became a unicorn in 2021 because of the flux of money that was out there. And so that's why the shock to the system when interest rates went up from practically 0 to 5.5% in just 18 months was quite tremendous. And that is a structural change that will probably remain for some time. So the outlook is clear in that interest rates will likely remain higher for longer, but the liquidity is still out there. There is still a lot of money. They're just parked in cash. That's why the banks, when you look at their net interest margins, that is quite high right now. That's why the interest rate curve is inverted, which means long end yield curve, the long end of the yield curve is lower than the short end, which means every time that interest rates go up in the long end, people go and buy those bonds. There is just a lot of money still available that's looking to deploy. And that is good for decarbonization initiatives, infrastructure investment, so on and so forth, as long as you are applying the right hurdle rate, which is not 0, it's closer to 5%. So there's a flood of liquidity out there. So that takes me neatly into my second D. What was the second D, by the way? Just to check if people are paying attention. Divergent globalization. Maybe just to mess things up a bit, let me do digitalization first. Because I mentioned there's a lot of money. And when you look at the S&P 500, and that is reaching record highs, that's also a sign there's a lot of money going in there. Now, how is that possible when interest rates are remaining high? Well, clearly because people are making some expectations about earnings. And what is the one thing that seems to be driving positive expectations about earnings right now? What could be driving the expectation for positive earnings? And this is under the category of digitalization. It starts with A. AI, that's right, sir. It's AI. And things become a bit clearer when you realize that what's happening to the S&P 500 is actually mostly happening to the S&P 7, not 500. Which are the 7 companies that are really driving the S&P right now? They're known as the Magnificent Seven. Microsoft, Apple, NVIDIA, Google, Amazon, Facebook, and Tesla. 7 stocks are about 30% of the value of S&P 500, and they drove about 70% of the growth in the stock market valuation last year. What were the other 493 stocks doing? They grew about 6% last year, which is hardly higher than the interest rate you could have earned by putting money in the bank. So if that is polarizing, so this is the feature of this era of digitalization, is polarizes value in a small number of companies. Do you guys remember when Facebook bought WhatsApp? That was already 9-10 years ago. Facebook paid $19 billion for WhatsApp. Do you know what was the headcount of WhatsApp at the time? It's less than 100. We think about 65 or so. So $19 billion mapping onto 65 people. Now, what will AI do to that dynamic? If we now think about AI, generative AI that has an unlimited pool of data that can be used to drive executive decisions, or at least assist executive decisions, and then drive robots and drones, it is not inconceivable to have a one-person company that could generate hundreds of millions of dollars in value. So the polarizing effect of technology is going to be greater than what we have seen even in the last 10 years, when I thought it was already quite extreme. I would say there are 2 takeaways from the second D of digitalization. One, every time people say the market is doing this, the market is high, the market is down, financial conditions are are loose, financial conditions are tight, you have to look deeper and ask, what do you mean by the market? Is it just 7 companies, or is it a wider group? Because there will certainly be a lot of winners, but there will also be losers in this digitalization drive. And the second thing I would say is that we do need to make sure that we maintain trust in digital. We need to make sure that when we talk about technology, we talk about use cases. And there's some wonderful use cases in decarbonization. You can use AI, for example, to better measure emissions or deforestation, things like that. So we need to really keep the focus on the use case as opposed to engage in futurology and talk about blockchain and crypto in a very general sense, because unless we make sure that there are ethical considerations in specific use cases, then I think we do a disservice to the forces of digitalization. All right, so divergent globalization that everyone has been waiting for. That's number 3. Let's just quickly think about how convergent globalization has been since the end of the Cold War. China joining the WTO, the European single currency. We know global GDP has been very strong, but global trade has been rising even faster than global GDP. So it really has been a very strong sense of convergence. In my previous career, I was in investment banking, and I could run a global business quite easily because the whole world was converging to the same style of doing business. And clearly today we're not in that situation anymore. Just a few years ago when the trade war started, there were conversations about whether it's going to be a Cold War or not. But today we have 2 tragic hot wars going on at the same time that have direct implications for prices, for supply. Do you remember, was it just a couple of months ago when the Suez Canal, ships had to be diverted from the West coming into Asia? They couldn't go through the Suez Canal, they had to go around southern Africa. The Suez Canal is roughly 15% of global shipping volumes. And going around Africa adds 10 days of transportation time to that. And that is a tremendous, 10 days is quite a bit. So geopolitics is real. Economic fragmentation, geopolitical fragmentation, you can now see in economic fragmentation as well. So if you take the United Nations General Assembly voting, and if you block countries into groups depending on how they vote, you look at recent data, and trade between the blocks has been dropping very dramatically. And then maybe the last point here is about the US dollar. The potential use of sanctions and freezing of assets might cause a search for an alternative to the dollar, even though at the moment I don't believe there is a credible alternative to the dollar. It is still the safe haven that people go to at the time of crises. But geopolitical consideration is an extra layer of concern that you might have when you're buying US dollar bonds right now. Because the US, as you know, has been running a fiscal deficit of 8 to 9% of GDP every year for the last 4 years. US debt has been ballooning. Just last year, the volume of new bonds issued added 10% to the stock of bonds that was already out there. So concerns about debt sustainability combined with geopolitics may have an effect of increasing a risk premium, whereas back in the day we were used to having a peace dividend because of the type of globalization that we used to have. All right, so maybe just one point before about US elections. I think irrespective of who wins the election, the instinct for America first, of reshoring production back to the US, that's going to continue. If you look at the Biden Inflation Reduction Act, subsidizing green investments, they didn't really care whether it meant businesses would leave France and come back to the US. So, and the EU is an ally. So it doesn't matter whether you're an ally or not, it is very much inward looking. And then if Donald Trump comes in and if he does implement that 10% tariffs on everyone, including the EU, with retaliation from them, then you also get the forces of deglobalization strengthen. So I don't think it's that much of a difference to the trend based on who ends up in the White House. So I've got 4 minutes or so left, and maybe I will talk a little bit about the last 2 Ds. What's the next D? Decarbonization, which is the theme of today. What I would say is that the period from 2015 to 2020 has been a fairly easy time for the progressive agenda, for climate change activists. What happened in 2015? We had 2 things happen in 2015. We had the Sustainable Development Goals announced, SDGs, and we had, of course, the Climate Paris Agreement. And the 5 years after that, central banks, other policymakers got together, came up with a lot of standards, alliances, reporting processes. The SGX in Singapore has been leading the way on many of these things. And so there's been a straight line progress on decarbonization. Now, it is a little bit more contested. There is a backlash, at least in parts of the West, certainly in the US. And some of the backlash is probably justified because it's reacting to instances of greenwashing, and it's reacting to instances where some of the genuine difficulties and trade-offs of transition have not been appreciated. And that's why the Singapore initiative on taxonomy, coming up with the transition taxonomy, is very important because it will take the discussion forward. So 2 things in terms of outlook from a decarbonization point of view. Number 1, keep an eye on the EU, because the EU Green Directive, which includes cross-border tax, carbon tax, will impact us here in Asia if we want to export to the EU or if you want to receive financing from European banks. And the second thing is corporate governance around sustainability needs to go up considerably higher than where we are today. It needs to be a lot more grown up, a lot more adult, and a lot more transparent in the way we do that. And the final D, in the final minute or so that I have, is demographics or population. Now, we all know that there are a lot of people in Asia. I mean, the number of people in Bangladesh alone is about the same as Russia and Canada combined. You can put 10 Swedens inside of Vietnam. So there's a lot of people. There's a fast-growing middle class. I think it quadrupled in the last 20 years in Southeast Asia. But also you have variable age dynamics. The Japanese average median is 49 years, about the same as a German. Thai and Chinese are 39 years, Indonesia is 29 years, India and the rest are even younger. So you have high variability, but of course you have aging across all of the countries. And so from an outlook point of view, we've got to think of the elderly, the aging part of the population as a big part of the consumers that we are catering to. So whether we're doing digitalization, decarbonization, any of the other Ds, we have to keep this demographics in place. So that's all that I wanted to say about the 5 Ds. I guess where I want to end is to say that a world of uncertainty is much harder to lead in than a world of risk. So the challenge for all of us, particularly those of you who are leaders of people, leaders of businesses, is to continue leading without inducing motion sickness when so many of the structural walls and the floors are moving. And there are certainly ways of doing that, but the premium will be placed on good forms of leadership. And with that, I bring my talk to an end. I thank you very much for your time. Thank you. It's been a pleasure.
Thank you so much, Professor Lutfey.